Joining us this morning, Renaissance Macro Research Chair Jeff deGraaf. Jeff, you've had some great tactical calls all year long. I remember talking about 4,300 with you maybe a couple of months ago. Talk to me about what you think is going to be most productive in the short term.
Yeah, I mean, it's a great question, Carl. I hope I'm on point here for the fourth quarter. I actually think there are several technical things lining up pretty favorably for the equity markets. You hit real yields, and there's no doubt that those are a problem, not only from a valuation perspective, but obviously the reverse of the TINA play. But I think in the fourth quarter, we've got a couple things going for us. One, sentiment is good enough. It's not spectacular, but it's good enough to provide for that seasonal tailwind that we historically get. We've had a pretty good oversold condition. We're retesting that. One of the things that we look at are 20-day lows. That spiked a couple weeks ago. That usually is some indication of a near-term washout. So I'm optimistic that we're going to climb to 44, maybe 4,500 between now and the end of the year. But I am concerned about those yields, and more importantly, that those real yields have now started to just indicate that BBB spreads are starting to move higher. And if that's going to be the case, that's going to be a challenging equity environment in 2024.
Yeah, we've mentioned auto delinquencies all day long, 30-year high. Gross and Ackman on the tape talking about, in Gross's case, recession in Q4. I guess, do those long-standing recession calls pick up steam here?
I mean, maybe they do. It's just not really our job. Neil Dutta handles that for us. He does a great job. He's not seeing that for fourth quarter or the first quarter even of next year. But he does think the Fed's on pause, and we certainly would agree with that given what the market dynamics are saying. So we are seeing deterioration in some of the industrials. Construction and engineering broke down in our work last week. Leisure products broke down. And I know those are more esoteric, but certainly they're interest rate sensitive, and certainly they are GDP sensitive. And so we are seeing some cracks at the margin there.
We've been talking all day about how miserable it's been in healthcare stocks unless you are in obesity. Are there opportunities here, or how do the charts look?
Yeah, they're not presenting themselves yet, Sarah, but the one thing that really jumps out to us is when we look at a 3-year rolling Sharpe ratio, which is one of the techniques that we use to just get an idea as to where things are too good or where things aren't are so bad that they might be good. We're getting that with healthcare. The healthcare 3-year rolling Sharpe ratios are abysmal. There's been really no salvation there other than maybe the distributors and a few select facility names or, just, again, a few esoteric names. But I do think this, and it reminds me of a couple instances in the past over my 30-year career, you're starting to see some of these just strange corollary effects. One that I mentioned is, airlines are going to be more profitable because people will be skinnier, and so airlines are a buy. Yeah, I start hearing crazy stuff like that. And I know that we're probably close to something.
Oh yeah, that's making the rounds.
Yeah, so you start getting those kinds of inputs, and it just becomes a little bit of a head scratcher that maybe the sentiment and maybe the belief is just too one-sided here. So I think there's good opportunities. We like to wait for relative strength to break out. That's not happening, but we think we're in the environment that if you will, quantitative contrarian zone where we want to start looking for and doing the work on names that we think will make the turn in 2024.